The massive 22% crash in silver prices from $90 to $73 in just 2 hours on the Shanghai Futures Exchange wasn't the result of a sudden shift in the underlying fundamentals of the silver market. Rather, it was the consequence of a leverage unwind. This term refers to the process where traders or investors who are heavily leveraged, meaning they've borrowed money or used financial instruments to increase the size of their positions, are forced to liquidate their holdings due to margin calls or other financial pressures. To fully grasp this concept, it's crucial to understand the role of leverage in financial markets. Leverage allows traders to control a large position in a commodity like silver with a relatively small amount of capital. For example, an investor might use leverage of 10:1, which means they can control $100,000 worth of silver with only $10,000 of their own capital. However, when the price of silver moves against their position, say, it falls sharply, they can quickly find themselves in a position where their losses exceed the amount they initially invested. This is precisely what happened in the silver market during the recent crash. Many traders who were long betting that the price of silver would rise at the $90 level were using leverage to increase their potential returns. When silver's price began to fall, these traders were hit with margin calls, which are demands by brokers or exchanges for additional funds to cover potential losses. If these traders couldn't meet the margin call, they were forced to liquidate their positions, exacerbating the selling pressure and causing prices to plummet. The key to understanding this point is to recognize that this event was not the result of a change in silver's fundamental value, such as a shift in supply and demand or a sudden disruption in silver production industry. Instead, it was driven by the mechanics of leverage trading. When leverage is involved, even small market movements can have outsized effects on the price, as traders are forced to buy or sell based on their margin requirements, not necessarily on their views of the asset's true value. The silver market, like many other commodity markets, has seen increased levels of speculation in recent years. This speculative activity can amplify price swings, making markets more volatile than they would be if only the physical demand and supply were in play. In the case of silver, this volatility is often driven by large institutional players and traders who use complex financial instruments like futures contracts, options, and ETF. While these instruments can provide liquidity and allow for price discovery, they also introduce a level of risk that can lead to significant market dislocations when large positions unwind. Despite this dramatic price drop, the fundamental picture for silver remains strong. Silver's role as both a precious metal and an industrial metal ensures that demand for the metal remains robust. On the industrial side, silver is crucial in the manufacturing of electronics, solar panels, and electric vehicles, all sectors experiencing strong growth. Additionally, as a safe haven asset, silver is often sought after during times of economic uncertainty, especially as inflation concerns rise and fiat currencies lose purchasing power. This divergence between the paper market, where leverage plays a significant role, and the physical market, where real metal is in demand, is crucial to understanding the true state of silver. While paper contracts and futures may be manipulated or driven by short-term financial strategies, the demand for actual physical silver continues to rise. Physical silver is being drained from vaults at unprecedented rates, with institutions and governments alike recognizing the metal's value as a hedge against inflation and economic instability. Thus, the recent price drop in silver should not be interpreted as a signal that the market is collapsing. Instead, it reflects the volatility and risk inherent in leverage trading. The fundamental demand for silver remains intact, and this event could even present a buying opportunity for those looking to accumulate physical silver at a lower price. Once the leverage positions are unwound and the dust settles, silver's price may well recover, potentially even stronger than before, driven by the same fundamental factors that have supported the metal's long-term upward trend. The recent crash in silver prices has revealed a stark and increasingly important characteristic of the precious metals market: regional divergence. This divergence refers to the differences in price movements and trading behavior between various geographic markets, such as the Shanghai Futures Exchange, COMEX New York, and the LBMA London. These markets are often viewed as interconnected parts of the global commodity system, but recent events have demonstrated that their paths can diverge significantly, particularly during times of high volatility and financial stress. The result of this divergence is extreme market volatility, which creates both risks and opportunities for traders, investors, and institutions. The silver market is traditionally global, with the key exchanges in the U.S., Europe, and China playing significant roles in price discovery. However, the recent price dislocation between these regions suggests that market dynamics are shifting. In particular, the Shanghai Futures Exchange has exhibited a remarkable divergence from Western markets. For instance, while silver futures prices in Shanghai plummeted during the recent sell-off, they continue to hold a substantial premium over Western prices. Shanghai futures were trading at $1.90, while Western spot prices and futures were closer to $1.75, $1.76. This $1.10 premium indicates that there is an ongoing physical demand for silver in China, even as the paper markets are experiencing severe selling pressure. This divergence between paper contracts and physical metal demand is a key signal of the growing separation between the two markets. In a healthy market, one would expect spot prices and futures contracts to be relatively aligned globally, as market participants arbitrage between regions to profit from any discrepancies. However, the current situation, where there is a noticeable premium in the Chinese market, points to physical tightness. The Shanghai Exchange, with its unique trading structure and a growing role in the global commodity ecosystem, is increasingly reflective of real-world demand for silver, while Western markets remain more speculative and financialized. This regional divergence is critical because it illustrates the tension between two very different forces in the silver market: speculative financial trading and physical demand. The massive volume of paper trading in Western markets, especially in futures contracts, has driven price volatility and created massive short positions. However, the physical market is not as easily manipulated. As silver becomes increasingly scarce in vaults around the world, countries like China and India, which rely heavily on physical silver for their industries, are creating a different market reality. This is where the divergence becomes apparent. While speculative selling drives prices lower in the paper markets, physical buyers, particularly in Asia, are willing to pay premiums to secure real metal. This phenomenon is a direct reflection of the growing demand for physical silver for industrial and investment purposes, especially as global uncertainty over inflation and financial instability increases. The extreme volatility seen in the silver market is exacerbated by this regional divergence. When different markets are behaving in starkly different ways, the volatility is amplified. Traders in one region may be forced to react to sudden price movements in another, leading to rapid sell-offs or buying frenzies. In the case of silver, the vast amount of paper contracts traded in Western markets may not fully reflect the underlying physical market's reality. This leads to price dislocations and erratic movements that don't necessarily reflect the fundamental supply-demand equation. For example, while Shanghai's futures market showed a $1.10 premium over Western markets, futures contracts in the U.S. and London were significantly oversold. This selling pressure came from traders who were short silver, betting that prices would fall further. These positions were exacerbated by margin calls, which caused traders to liquidate their holdings, driving prices lower. At the same time, physical buyers in China and other countries were actively purchasing silver at higher premiums, which indicated that demand for the actual metal was not slowing down. In essence, this divergence between paper and physical markets is creating a volatile environment, with significant fluctuations in silver prices that are not entirely aligned with the metal's supply and demand dynamics. The discrepancy between these regions signals a breakdown in the way the global silver market traditionally operates, and it raises important questions about the sustainability of the financialized silver market. As more investors and institutions begin to recognize the growing divide, it could lead to greater demand for physical silver, further exacerbating volatility in the paper market and driving prices higher in the long run. For investors and traders, this regional divergence presents both opportunities and risks. On the one hand, the disparity in prices between regions might offer arbitrage opportunities, where one can buy silver in one market and sell it in another for a profit. On the other hand, it signals that the market is under stress and that prices could continue to move erratically as the pressure builds between the paper-driven markets and the physical metal demand. In conclusion, the extreme volatility in the silver market, amplified by regional divergence, is a signal of the broader tensions within the global financial system. As paper markets face immense pressure from speculative selling, the physical silver market continues to absorb demand, leading to a fascinating contrast between paper prices and the physical reality of silver's value. The divergence between the Shanghai Futures Exchange and Western markets is a reflection of the growing complexity of the silver market, and it suggests that traditional price discovery mechanisms may no longer apply in the same way they once did. As global demand for physical silver increases, the gap between paper and physical markets could widen further, making the silver market more volatile and unpredictable. One of the most pivotal changes occurring in the silver market today is the shift from paper-driven price discovery to physical-driven price discovery. This transition marks a fundamental transformation in how the silver market operates, and its implications are far-reaching, not only for silver, but for commodities in general. To understand this transition, we need to first distinguish between the two types of price discovery mechanisms: paper markets and physical markets. Paper price discovery refers to the prices set through financial instruments such as futures contracts, options, and ETF exchange-traded funds, which allow participants to speculate on the price of silver without necessarily owning the actual metal. These markets are highly liquid and are dominated by large institutional players and financial entities who engage in trading with leverage and margin, making the market more susceptible to speculative moves. Price discovery in these markets is often detached from the actual supply and demand of the physical commodity. It is influenced by investor sentiment, trading algorithms, and macroeconomic factors, which can sometimes lead to prices that diverge significantly from the actual availability of the metal. Physical price discovery, on the other hand, refers to prices that are driven by the real-world demand and supply of the commodity, silver in this case. This market is less liquid and tends to operate at a slower pace compared to the paper market. Prices are set by physical buyers and sellers, such as miners, refiners, manufacturers, and investors who want to hold the metal. Physical price discovery reflects the actual scarcity or abundance of the commodity in its real-world usage, particularly in industrial applications like electronics, solar panels, and electric vehicles. In this market, supply and demand play a much more direct role in setting prices, and the volatility typically observed in paper markets is less pronounced. The shift to physical price discovery has been prompted by several factors, but perhaps the most important is the growing divergence between paper markets and physical demand. The recent dramatic price moves in silver, such as the 22% crash followed by a significant premium for silver in the physical markets, are clear signs of this transition. Even though the paper market saw a substantial sell-off, the physical market remained tight, with silver premiums still holding strong in regions like China, where demand for real metal is robust. This premium indicates that physical buyers are still willing to pay a premium to secure the metal, even as prices in the paper markets decline. A key aspect of this transition is the shrinking supply of physical silver. Recent data highlights that large quantities of silver are leaving vaults, with millions of ounces being withdrawn from major precious metals depositories like COMEX and HSBC. This is a clear indication that physical metal is in short supply. At the same time, more and more futures contracts are being settled with actual metal rather than cash, suggesting a significant shift toward physical delivery. Traditionally, only a small percentage of futures contracts are settled with physical metal, but the recent surge in demand for physical silver has seen almost 100% of contracts settling physically. This behavior underscores the growing importance of the physical market, as traders and investors alike realize that owning the physical commodity is becoming more critical in the face of increasing supply shortages. The role of government and state intervention in this transition is also notable. Governments are increasingly recognizing the strategic importance of precious metals like silver and gold. Many nations have started to increase their stockpiles of physical metal, particularly as a hedge against inflation and geopolitical uncertainty. For example, the state of Wyoming in the U.S. recently began buying physical gold and placed its holdings in private vaults, bypassing traditional financial institutions like J.P. Morgan. This marks a significant shift in how institutional investors view precious metals and highlights the desire to move away from paper-based systems that can be manipulated or exposed to systemic risk. This transition from paper to physical price discovery represents a fundamental breakdown in the traditional financialized market structure. In the past, price discovery in commodities like silver was primarily driven by financial instruments and speculation in paper markets. However, as the physical market becomes more constrained, prices are increasingly reflecting the real scarcity of the metal. This shift is a direct result of the ongoing tightness in supply and the rising demand for silver for industrial purposes. Physical markets are absorbing metal at a much faster rate than paper markets can accommodate, and as a result, prices in the paper markets are no longer a true reflection of the underlying fundamentals. This transition is also a sign of the broader breakdown of the neoclassical financial system, where markets were expected to operate based on efficient price discovery through speculative instruments. The increasing reliance on state intervention, government, imposed price floors, and regional policies, as seen with the Shanghai Futures Exchange, is signaling a shift towards a new era of commodity markets where real world supply and demand will take precedence over paper-based speculation. In conclusion, the transition from paper to physical price discovery in silver is not just a temporary anomaly. It marks a long-term structural shift in how precious metals, and perhaps commodities in general, will be priced in the future. As demand for physical silver continues to outstrip supply, and as institutional investors recognize the value of owning real metal rather than paper contracts, this transition will only intensify. The silver market and potentially other commodities are moving towards a future where physical demand will increasingly dictate price, and where the financialized paper markets will be less influential. Investors who continue to rely solely on paper contracts without securing physical holdings may find themselves increasingly exposed to risk as the market structure evolves.